Okay guys, very good morning. Hope everyone is well. It's Wednesday the 13th of December, so getting the briefing underway. Give a quick overview of what we're going to cover. We're going to have a look at the news overnight in regards to a defeat in Alabama in the US, in regards to then a changing slightly of the composition of Senate seats and what does that mean going forward, and has there been much reaction to that. We'll also then have a look in more detail at the Fed announcement which is coming this evening, this being a key one because this is one of the 4 meetings we get in the 8 meeting cycle throughout a year, of when we get not only get the decision but we also get the summary of economic projections, or the dot plots, and we also get the press conference with Janet Yellen as well. So quite a few things to discuss. So let's get straight underway and have a look at the charts firstly this morning to see things as they stand. And a fairly muted open. This is because, as I just mentioned, you've got the Fed decision, and that really commences then the central bank theme for the week, because you're going to get the ECB and the Bank of England to follow, which will be on Thursday. And then you've also got some very influential, probably the most important economic data to monitor coming out of the US at the moment, and that's the CPI reading. And we'll have a look at that in a second. One thing, though, to get things underway is you'll notice that if you were trading the Bund this morning, so if I flip my chart here to the Bund in the bottom right hand corner, you'll notice that we didn't actually start trading until well after the open. This was because of an issue on the Eurex exchange. As I understand, it was just a technical issue at the exchange. It has since been resolved and everything is now operating and working as per normal. But one thing I just wanted to quickly show you on the Eurex website, it's just reloading here at the moment, is that what they do is they update market statuses very quickly. Now you probably can see a video shot in the bottom right hand corner of my screen I'm showing, but just underneath that there's basically a button. If there's ever any issues with the Eurex website, the first thing you do is just go on the Eurex exchange website, you hit the pop-up which they have as an alert system, and then you go into this page here with a subsection where it gives you ongoing updates every few minutes as to what the situation is. So if you're ever trading the Bund or associated Eurex products, for example, the DAX and so on, then obviously this is the ways and means as to not panic. You can just go here and follow the updates to find out what exactly is going on, to monitor those positions. So just a notation going forward of how that works. But having a look firstly at the charts, equity markets are pretty flat overall. There's not too much movement happening at the moment. Really, that's very much mimicked elsewhere. The currency pairs are pretty flat overall. Gold up just marginally and sitting around pivot for the time being. So as I mentioned, a lot of people waiting for this evening. But before that, there has been some news overnight. Got to give a shout out to Jose Stubbs. He's always got his finger on the pulse of the markets, and he knows, or he posted a trade idea that he was looking at for the market open this morning. The thing I like about excuse me, the thing I like about Jose is that, you know, he it's one of those things where for him the market never sleeps and he's always looking at the news. But the really good thing to see is, you know, he's not shy of committing to an idea, which I think is, you know, that conviction can definitely be something which will serve him well in the long run, definitely from a trading perspective. Clarity of thought, which would enhance his ability to execute in that kind of situations, is the point I'm making. But the headline that he was looking at, and to talk about a bit more, was this one. And this is because Republican Roy Moore in Alabama was defeated in a Senate race by Democrat Doug Jones. And this is quite unprecedented, really, because it is basically, it'll be the first Democrat to win a Senate seat in Alabama in almost 25 years. So this particular seat is known as a deep red seat. If you go back to 2016 during the Trump election, you know, it was heavily sided in favor of the Republicans. And what has happened here is then, does this switching disrupt the ongoing and the biggest factor here, the US tax plan going forward. Now, one of the important things here is the devil's in the details, and Mr. Jones is scheduled to take office before the 3rd of Jan, but not until the new year. So Deutsche Bank analysts were making a good point this morning. So basically there's not enough time, if all things from the administration side is being well, and they can compromise between the two versions of the existing bill between the two chambers, the House and the Senate, and bring forward a firm piece of agreed legislation to the President for sign-off before year-end, which is the plan at the moment, then actually this change of Senate seat shouldn't make a great deal of difference. In terms of numbers, the reason why, though, that this is significant going forward for 2018, and if the tax bill doesn't get done, and also, let's not forget, there's still an awful lot more that the Trump administration needs to also implement in terms of infrastructure spending plans. We've still got regulation to talk about as well, so a number of different things to still factor in. And essentially, in terms of the Republican-run Senate majority at the moment, it now is only 51 to 49, and that's dropped obviously from 52 to 48. So it could impact the prospects of future bills being passed. CNN noted that 1 in every 20 votes so far this year in the Senate would have had a different outcome if just one vote had flipped to the opposite side. So 1 in 20 would have changed. So it's not a complete game changer that everything would have been different, but certainly does change the context. And it means that, you know, in terms of some of the tax bill discussions that have happened so far, it only takes a couple of Republicans not to agree, the fact that Democrats might be against it, and then all of a sudden the whole deal kind of falls flat at that point. So the impact on the market this morning, as you can tell, has been minimal. And I think this is a lot of the byproduct of the timings. As I said, the Democrat Doug Jones won't come in until the new year, of which time, all things being well, the tax plan probably would have been signed off by then in some shape or form. Now, the latest on that particular side of things at the moment is that House Ways and Means Chairman noted the conference panel could deliver written agreement on the final tax legislation actually by this Friday. The House Majority Leader, McCarthy, told GOP members the goal is for the House to vote on the reconciled tax bill by next Tuesday, and then obviously this then gives them a bit of time to put forward then to the President. So that's the situation there, and as I say, the market reaction hasn't really been a great deal, so I don't think it's anything too much to stress about at this point, but obviously the long-term implications could be interesting. Let me just bring up a chart that I tweeted a few days ago, and obviously one thing we are going to be looking out for coming up in the future is that of what are the political main events to look out for in 2018. And certainly one thing which a lot of people will look at very closely is the midterm elections in the US. Now, I know this is a bit small. Let me see if I can make this a bit bigger here so you can see it. So these were a couple of political events to be aware of, and we've just had some more confirmation this morning. The Italian press, the La Repubblica, saying that Italian parties, they've agreed now to hold elections. They've firmed up a date, and that definitely will be one of the more interesting political events to kind of bookmark the end of Q1 really of next year. That's going to happen on the 4th of March. So that's going to draw Italy back into focus, because they've kind of taken a back seat after we had that banking run of sorts at the end of 2016. It's kind of come up slightly recently given the re-emergence of Berlusconi and also some of the voting patterns that we've seen of late, but obviously the general election in March will be key. But the one I'm looking at here that a lot of people will look at later on will be the US midterm elections, which is going to happen in October of 2018. So it's not for a while yet. I guess the one thing that is definitely going to happen between now and then is what can the administration pass in the interim period. The more that Trump can pass, then the more authority that you would say that he will command at that point, because then he's going to be a guy who's, you know, backed up his bark, if you like. And at this point, though, he hasn't really done that. The passage of the US tax bill is obviously going to be the first step to implementing that. So it's definitely, you know, does have some implications going forward. And particularly because there's a hell of a lot more that Trump has on the agenda still to push through. It's just that things like the repeal of Obamacare, for example, it's taken an awful long time for him to get to a point where, you know, things are getting passed, so to speak. Okay, the big thing and the thing that a lot of the market's waiting for is, of course, everyone's favourite. Here she is. How can you resist that smile? That is Janet Yellen, of course. And it is going to be her farewell press conference, because she's going to be finishing, of course, in February. She'll hand over the reins to Jerome Powell. And so dear Janet, who's steered the ship for the last several years, will be stepping aside. Now, before we get into the crux of the press conference where she's going to be talking, first of all, let's look at the situation here. And one of the main things is the Fed are going to hike interest rates. And as far as the market is concerned, by market pricing, we are 95% positioned for the fact that the interest rate in the US is going to be lifted from the current 1 to 1.25% to 1.25% to 1.5% federal funds target range. This will, in fact, then be the 5th rate hike. I know it's quite, actually, when you put it in that context, you know, I think the Fed have done a very good job actually this year. I think they went through last year, 2016, lost a degree of credibility given the fact that when they initially commenced the first rate hike, so if we go back to this one here, if you guys remember, this was December of 2015, the first rate hike that was seen. And at that point, that was when the Fed told us, when we go into 2016, we're going to raise rates 4 more times. And obviously, it was far from that. They only executed the one at the end of 2016. The one thing, though, that Janet Yellen's managed to do this year is that I think she's played a pretty straight hand, and she's kept communication probably the most constant out of the major central bankers. I think Mark Carney is probably the one that's flipped and flopped the most from pillar to post of hawkish and dovish. I think now we're a little bit more clear in terms of rate hike trajectory going forward. The Bank of England, as you can see here, the red line, this is where we are at the moment, the dotted line signifying the rate path trajectory going forward. So as far as the Bank of England are concerned, we're not really looking for rate hikes really until end of 2018 and the end of 2019, and so by 2020, you know, we're going to be at the grand sum of 1% in interest rates, a whole 0.5% higher than where we are in today's interest rate level. The Fed, on the other hand, we're going to be knocking near 3% by the time that the Bank of England is at 1. That's the current trajectory at this point in time. But what's interesting here is that 2017, you know, Yellen, I think, has done an excellent job. She said what she's going to do. The market was disbelieving in terms of positioning itself more dovishly, but she's continued to follow and deliver in terms of the communication from the central bank. And as such, we've had our 2 rate hikes in addition to the one that was seen at the end of last year, and now we're ready for the next one, of which the market is very much priced for. So don't forget, in terms of the execution of the event this evening, it's definitely not about the rate hike itself. This now becomes irrelevant, actually, in terms of how the market might react. The only thing that could potentially move in that part of the announcement would be if they didn't hike rates. That's, as you can tell from the previous chart, there's only a 5% or less than 5% probability of that happening. So we can make the educated decision that that's not where the focus will be. They'll hike. So then what are people looking at? Well, they're looking at this. So just to recap, this is the Fed dot plot matrix, identifying in the bold here the median dot plots going out from this year So how the dot plots work, just to refresh any of the newer traders, this is each dot representing a Federal Reserve member. Obviously, the higher the dot, then the more hawkish that member's view is on monetary policy, i.e. by the end of the year, as identified by the bottom axis here, this year, next, 19, 2020, and what's deemed called the longer run. This is where the most hawkish person sees rates at the end of that period and the most dovish. And then the median dot plot is the actual consensus. So this was June in red, and this is the subtle change that we saw in September. And what's been the pattern really from Fed interest rate hikes is that in order to bed in a continuous rate hiking cycle, the central bank's strategy, generally speaking, has been to talk relatively dovish, and so that the market doesn't get spooked by the fact that you are tightening policy. To take that up a notch, obviously we're into the period of quantitative tightening as well, which commenced as of the beginning of October. So the swollen balance sheet that's the Fed, that stands at $4.5 trillion, is now starting to be faded back down, albeit in an incredibly incremental process going forward. So only very small amount of bonds are being allowed to mature and not reinvested is the main point. Going forward then, what we're looking out for here is, this is June, so we can take out the red dots, and what we'll be looking out for is a new colour, so let's say black, and it will be the December, and it's the comparison between these trajectory lines of September as to December. What is the difference and how different do they look? Now in September, Fed officials projected 3 rate hikes in 2018, 2 more in 2019, with rates settling at 2.75% in the longer run, as you can see here on the right hand side. Now, a couple things to keep in mind here. US economic data, generally speaking, has been continuing to improve and has done on balance, you would say, since the period of September. Growth is tracking around 2.9% for the fourth quarter, according to the Atlanta Fed, following 2 quarters of above 3% growth. We've also got Donald Trump and Republican lawmakers also looking to close in on this package of corporate tax cuts, which will help lift growth. He can then go on to focus on other administrative issues, like the implementation, or at least a discussion of large-scale fiscal stimulus through infrastructure spending. You can also start to move on to watering down of regulation, for example, of which also fits into the mold of something which the new Fed chair, Jerome Powell, will be more fitting with, rather than Janet Yellen. And so actually what you can probably anticipate is there might even be a little bump up in these dot plots coming this evening. So instead of having this typical more dovish hike terminology, actually I think today will be more of a neutral, if not a slightly hawkish hike. Now the problem, there's obviously a big risk if you go too hawkish in the surrounding projections and the accompanying commentary. You can spook the market. So if it is hawkish, I only imagine it will be on the very slight side, but I don't think you're going to get a particularly dovish hike this time round, because I don't think the underlying US economic performance and improvement and the rate of which it's improving warrants them being so cautious going forward. So definitely this is where the balance of market reaction lies. And then of course we flip back and then we're looking for Janet. So she'll give the press conference. So the way that this will work is at 7 p.m. this evening we'll get the announcement, you'll get the hike, you'll get the summary of economic projections, which will include the dot plots and the updates on inflation, GDP, and the unemployment rate, and so on and so forth. This will help us determine then the trajectory going forward. And then Janet will come on half an hour later, host a press conference, usually lasts about 45 minutes. And that's when we'll be trying to hear of anything she has to add. Now, some people might think, well, if you're leaving your post, well, why not just be quite brash and bold and say what you really think? But we're not talking about Donald Trump here, we're talking about Janet Yellen. And Janet Yellen is an absolute team player, and she's definitely not going to make Jerome Powell's life harder than it needs to be. So I wouldn't be expecting any fireworks on Janet's last press conference. I'm pretty sure it's going to be more of a, she'll just want to finish on the fact that actually everything she said she was going to do, she's delivered. And then handing over the baton to Jerome Powell going forward. We'll talk about this more. If you want to tune in live, I'm going to be here all night covering it. So you just need to go to tradinglive.com and then join us in the chat room if you want to watch it from home. Okay, a few other things quickly to wrap up. Let's have a look at WTI crude. And we've had a little bit of an uptick overnight. And really, I'm just looking at this point here, which is at 9:30 last night. Of course, Tuesday evening, we get the API crude oil inventories, which set the scene for the Department of Energy numbers this afternoon. So what were the numbers? Well, we had a drawdown in crude, 7.382 million. Expectations were for a drawdown of just shy of 3 million. So the drawdown in last night's API crude was more than double than what was expected. It was the biggest drawdown in 4 months. Cushing was a drawdown of 2.7 million. That was also just a slightly larger draw than expected, draw of 2.5. Gasoline, though, on the flip side, was a build of 2.3 and still it's a build of 1.5 million. But overall, on balance, the headline and the Cushing outweighing that of the gasoline, and the market has moved a little bit higher since that's come out. We've added about 40 cents or so to the current price of WTI crude. Would I want to just jump in here at pivot and just keep pushing the price? Well, put into context the market positioning here, we have already moved from around a price point of 57.25 up to 65. So as I said, we've added a decent amount of cents to the price movement in the overnight session so far. And so now it might be just a case that the market will sit around these current price points just awaiting for the data to hit later. So DOE numbers, of course, always adds a degree of fluctuation to price activity, so something to look out for. While we're on the subject of crude, one thing obviously we've been monitoring yesterday and we were talking about in the briefing was that of the North Sea situation, the pipeline incident that's happened that's caused Brent to move to new multi-year highs, and in sympathy we were looking at WTI crude, which was rising. However, that has come back during part of yesterday's session, only to be countered on that fall by this latest inventory numbers. But one thing is, if crude overall, in a longer perspective, the commitment from OPEC to extend those ongoing cuts, and now some of the issues that are happening on this pipeline with a crack that's been reported, then if Brent, WTI and crude prices remain elevated, what does this do for the read across then for inflation? We've talked about before many times, and if you listen to the Fed speakers, ultimately the most important thing that they're monitoring is inflation. This tightening of the labour force that they've foreseen will ultimately create then an increased demand for employees and therefore higher wages, and that will consequently lead to then net inflation as demand increases. Will this materialise? Well, one would say that the Fed are right in their thinking, economic conditions are improving, but then secondly, if oil does remain higher, then certainly this starts to feed into inflation in that respect as well. So definitely the CPI numbers today, I would say, will probably be the most key part of the session during the day. If you are going to trade those numbers though, then I would be a little bit realistic with your kind of strategy in terms of the timing of execution, because don't forget the Fed meeting is going to happen later in the evening. So it could be a case that traders will monitor this data, and if it is, let's say, out of line, they might trade it, but in a very short time frame fashion, to then want to be out of the market, to then await and then position accordingly to take advantage of any moves that might come on the back of the Fed announcement at 7 p.m. One thing to be aware of course, we had the PPI numbers yesterday, and they were, both on the year-on-year and core reading, a little bit higher than expected. Now, expectations today for the US CPI is year-on-year to tick up to 2.2 from 2%, and the core reading to maintain a 1.8% print. But as what we saw yesterday, be looking for the same type of price reaction. If we did get a higher number, let's say that core reading starts to bump up back up toward 2%, then definitely looking for dollar strength, higher US yields, and then some pressure on gold as well under that particular scenario. In the interim period, other than new oil inventories at 3:30, the other thing to look out for is the wage data from the UK. And so that's at 9:30. Yesterday we had inflation, and that ticked up to 3.1%, which is more than a 5-year high, and means that Mark Carney needs to throw in a letter to the Chancellor along with his Christmas card, because he needs to explain why he hasn't done a particularly good job at keeping inflation on target of 2%. And so one thing that was interesting is we actually sold off in cable. Yes, we recovered, but rather than a traditional move of higher inflation equals higher rates and appreciation of the pound, actually higher inflation at this point has created then more pressure on the consumer. And that's worrying long term for the longevity of the economic situation in the UK, particularly under the cloud of political uncertainty and the pressure of that squeeze ongoing for household incomes with lackluster wage growth. So the wage numbers today are absolutely key because we've got heightened inflationary conditions, but are wages keeping pace is the key question here. We've had a little rise in cable here more recently, and we've just managed to creep back above pivot for the moment. But that data coming up in about 20 minutes, so I'll come off the mic shortly and let you guys get on with that. Looking at the wage number just quickly though to finish things off, this is what it looks like at the moment. And as you can see, wages have really done absolutely nothing over the year-to-date performance. If you were net averaging this out, then we literally have stayed stagnant at 2.2% and constant. So if you map this over inflation, then the two lines continue to diverge. And that is problematic for the economy going forward. And then we'll get retail sales, of course, tomorrow on Thursday. So this is the chart I was just looking at. Okay, guys, going to leave it at that. So that data coming up shortly in about 20 minutes or so. So good luck for that. And as I said, US CPI is going to be the main focal point of the afternoon. And then the Fed later I'll be covering live. So feel free to join us on Trading Live. Okay, have a good day. Thank you very much.